Hey, I'm Jonathan Wild, and we cover how to record large stock dividends. A stock dividend is a distribution of additional shares of stock to its investors. Like a cash dividend, stock dividends are declared by the corporation's board of directors. However, unlike cash dividends, stock dividends do not reduce assets or total equity. Now, the accounting for stock dividends depends on whether the corporation declares a small stock dividend or a large stock dividend. A small stock dividend is when the corporation distributes 25% or less of previously outstanding shares. And a large stock dividend is when the corporation distributes more than 25% of previously outstanding shares. In this segment, we will focus in on large stock dividends and cover small stock dividends in another segment. Let's do an example to show how to account for large stock dividends. So, similar to cash dividends, we focus in on 3 dates: the date of declaration, the date of record, and the date of payment. And we start with the date of declaration. So, assume a company declares a 40% stock dividend on December 31st. The company had 25,000 shares outstanding before the declaration. So, the stock dividend is for 10,000 shares. The par value of each share is $1. Now, when recording the declaration of a large stock dividend, we capitalize retained earnings for the par value or stated value of the additional shares being distributed. Capitalizing retained earnings means we basically transfer part of our balance in retained earnings over to common stock. And par value or stated value of the additional shares is computed as 10,000 shares being distributed multiplied by the $1 par value. This means the total par value of these shares is $10,000. Now, to record the declaration of the dividend, we debit retained earnings for $10,000 and credit common stock dividend distributable for $10,000. We debit retained earnings to reduce this equity account for the par value of the distributed shares. We credit common stock dividend distributable, which is an equity account that is only in the accounting system until the shares are distributed. After the declaration, total equity has not changed at all. We decreased one equity account for $10,000 and increased another for $10,000. The next important date is the date of record. In our example, that is January 10th. Anybody who owns the stock on the date of record will receive the stock dividend. We don't make a journal entry on the date of record because we are just determining who will receive the stock dividend. Next up is the date of payment, which is the date when the corporation makes the dividend distribution. The date of payment in our example is January 16th. To record the distribution, we debit common stock dividend distributable for $10,000 and credit common stock for $10,000. All this entry does is transfer the $10,000 balance out of the common stock dividend distributable equity account and transfer it to another equity account, common stock. We do this because the common stock has now been distributed. In the end, total equity has not changed from before the large stock dividend. All we did was transfer the par value of the large stock dividend, which was $10,000, from the retained earnings account to the common stock account.